morning to you. Happy Friday. Finally. This week feels like it's just, I got beat up every day, especially when the Federal Reserve came out and did all their stuff and the banking stuff and everything else. So what we want to do today is talk about basically what the markets are doing, how they're reacting, some economic news that came out today. There's really not that much data out, but you can see on your screen what the bond market's doing. I got real interesting information for you guys on the bond market. The yield curve is really flattening, and it's because what the Federal Reserve's doing and all the other repercussions of things. So does that mean maybe there's not a recession in the mix? That's what we're going to talk about here in just a little bit. But let's go over the indicators and the markets and just get a cap on what's going on, and then I'll give you my feedback, what I think is going to go on, and we'll go over mortgage rates at the end of the video. So right now what you're seeing on your screen is basically what the bond market's doing. We got the 10-year treasury right here. It is down 4 ticks. We have the MBS market, it's up 3 ticks, and the MBS 5.5 is up 2 ticks. What in the world? Why do we follow this stuff? Well, basically I want to see what the economy is doing with the direction of, because I follow a lot of this stuff to see, is a recession really built into these numbers? And also why I follow the MBS market. If you're in the mortgage business, or you're a realtor, or maybe even if you're a consumer, you really want to kind of know what's going on with interest rates. But I wouldn't suggest you get a program like this. If you're a mortgage advisor, I would suggest using this tool. If you want to subscribe to this, you can subscribe down below. You get a discount, and I think I make $1 if you subscribe to it. So don't really care if you use it or not. You can just follow me every day, because I'm going to try to do this under 10 minutes to give you guys a recap on what's going on in the markets. So we can see here, like I said, the bond markets are just basically doing nothing this morning. But let's go over to one caption that we're going to see. We have some manufacturing numbers that just came in, and here's what the numbers look like. And this is where it's showing you the economy is slowing down because people are starting to not spend on bigger items. So that means they're pulling back on some things. Does it mean they're pulling back on everything? No. I went out to dinner on Wednesday, and we went to just a burger place in the town next to where I live, and the place is packed. Completely packed, and it was a Wednesday, so it's like people are still going out and spending money there. I can't blame them because I'm doing the same thing. So let's get over to here. Here's what's telling us what's happening on the overall manufacturing piece of the puzzle. You can go back to here, and any indicator under 50 means there's somewhat of a retraction in people purchasing things, and we check it out on the manufacturing side. So what we want to see is what's the consumer doing, and if the spending's starting to come down on the manufacturing side, it's going to even come down even worse. So we're watching what's happening on the manufacturing because they have a beat on what the consumer's doing. Hope you get that. So what you're seeing on your screen right now is what that index is showing us. Any reading of 50 or above means the economy or the consumers are buying more bigger items. A retraction is anything under 50. So here's what we see for the readings from October 2022 to now. We have the reading going from 49.9, basically 50, down to 47.8. So it's retracting. So that's telling me the markets and the manufacturing side are retracting. So let's go over to the economic news for the day, and you can see right here, core durable goods orders. That's core. They strip out some items month over month. The previous reading was 0.4. Expectations were to come in at 2.2. Came in flat, completely flat. So that's not very good. The previous reading right before this one was 0.5. So we're coming down substantially on core durable goods. What does this tell us? Well, basically, people are buying less bigger items. So what does that tell us? Well, think of it. If people are buying less bigger items, the manufacturer doesn't have to make as much. They don't have to get as much supplies. They don't need as much labor, such and such and such. So there's going to be a retraction. There's going to be a recession, folks. If you like it or not, it's going to be a pullback in the economy. The good news with a lot of this is if you're in the mortgage business or you're looking for a home, mortgage rates in the last 5 recessions decreased over 1.8%. So when we're at the end of this video, I'll show you where rates are. Have we come off of that, or are markets already preparing for that? That's what we're going to talk about here in a minute. So let's go over to calculated risk. I greatly suggest you guys, if you're in the mortgage business, subscribe to this guy. He's phenomenal. He gives you a lot of context. He's got no skin in the game. He just tells it as it is. It says Realtor.com. That's what he's reporting for. So if you don't like Realtor.com, you don't have to listen to this, but this is how we get our data, folks. Don't think everything is biased. Read in all these articles, and that's what I'm trying to teach you. Get your data sources all over the place, and then you make your decision on what you think you should be doing. But right now we have Realtor.com reports weekly activity inventory up 59% year over year. So what have we been talking about? Well, the only way to really drive down prices of homes even more than it's been, and it hasn't been that substantial. People are saying, oh, the markets are crashing, crashing, crashing. Well, we finally just had a little retraction in housing. But to really help stabilize the markets, we need more and more inventory up, because if you follow all these articles and all the data, new listings are down 20% year over year. So the inventory is still not there. So if you're out there looking for a house, it's really difficult right now because there's not a lot of homes on the market. We're having a lot of existing homes not coming to market. So we need that void filled by the new builds. So if you're looking for a house, a lot of people say, Dan, is this a good time? I'm seeing houses on the market, but nothing's really coming on. Hold tight, folks, because the hottest part of the season is coming up. We want to prep you guys. If you're sitting on the sideline right now, you might get a little reprieve in interest rates. And if you're already closed, check out and see if a refinance might be good for you. But if you're looking to buy probably in May through June, you're probably going to see some major products or major homes coming to market, and you might get a nice little reprieve on mortgage rates. So we want inventory to go up to give you guys more options when you're buying, plus to stabilize prices. Because again, if your supply demand, if your demand's staying steady, and it's down quite a bit from where we were like 2 years ago, but it's staying steady at these levels, if we have low inventory, that means we're going to have to pay up because there's more people competing for a house. There's more inventory, there's more options, there's more leeway for you to get a better price on homes. So that's what we're seeing there. What are we seeing in the overall markets? The overall markets are still continuing to get pounded by news about banks and all this other stuff. Please, guys, relax on the bank front, okay? I can almost assure you that this isn't going to be systemic, meaning it's not going to run to all banks throughout the country and then hit Citibank and all these bigger banks as well. It's basically centralized in a focused area. Sorry about that. But the media, if they blow it out of context, they're going to get you to watch and see, okay, what's going on? Another bank going out of business. But let's look at it this way. Do you really care? Well, you kind of should, but you kind of shouldn't. It's like the housing market. If you're in Oklahoma, the housing market in San Diego is dropping. Why should you care? And I don't mean that in a rude way. Unless you're moving to San Diego, you shouldn't really care about that. What is your market doing? And that's why I want you guys to focus in on. Okay, so the markets right now, the Dow Jones is down 172, S&P is down 20, we got the NASDAQ down 65, VIX is up, so that's telling me people are a little scared today. And we'll try to dive in to see what the fears are. But God, if you wake up every day and all you hear is, this is going wrong and that's going wrong, and thank God we don't have the COVID ticker every day that at the bottom of the screen telling us how many people died for the day. That was crazy. You'd sit there and it's like, okay, I get it, but you don't have to really throw it. That's my analogies. So the VIX right now is up. That means the markets are volatile. People are a little nervous on the sidelines. We got gold down a little bit, and we still have, look at oil, continues to drop and drop and drop. It's down another 2% today. If we go over to here, look at the chart for oil, and I know this is a stickler in my butt, but just a little bit ago. Well, let's go back to what chart can we get? Let's just get a 3-month chart. Okay, can you if oil prices were at 81 and now they're at 68, why isn't oil or gas at the pump going down? And some of you guys said it's supply, it's the switch over, whatever. It's still nuts, because if you go back even further, let's go back a year. When oil was $122 a barrel, now it's about half of that. But the gas prices are just a fraction off their highs. It's a really my pet peeve. Here's my rant of the day. When you're going and getting your driver's license, are you told to always drive in the left-hand lane, even if you're driving 30 and the speed limit's 60? You guys, you ever get, you have somebody that pulls out in front of you and they automatically get in the left lane and they continue to drive 30 and there's a whole line of traffic behind them. You got to swerve around and pass them, which you're not supposed to pass on the right, and then get in front of them. They're just sitting there driving along. Guys, get in the right lane. That's my rant of the day. Okay, so let's see the other markets. We're watching the bank stocks to see what they're doing. And guys, Some of these are going to recover, some might not. So for example, we go through here, Signature Bank has basically halted. They're at $70 a share, and I don't think they're even trading anymore. UBS is down 3.5% today. So again, the banking fear, the media is just pounding this out there. So it might be a good time to look at some of these as an investment. I own an ETF called XLF. It's a basket of financial stocks. I'm not telling you guys to buy it. I'm just giving you guys educational tools because I'm not a licensed broker. I don't do this for a living. Don't take my advice for trading purposes. Use it for entertainment and educational purposes only. Legal disclosure. Okay, so you're seeing these. They're down 3%, 1%, 5%. Credit Suisse is getting bailed out. But before you do any of this stuff, please read into what's really going on behind the scenes. But I think there's some hidden gems in here for you guys to pick up on. Let's go to yields right now. So everybody's saying that we're possibly in a recession or getting there really quick. One of the tools that we look at is what the yield curve is doing, and we want to look at the 2-year Treasury, because the 2-year Treasury, let's look where it was and where we've gone from now. So look at this as an investment vehicle. So in December of 2020, the yield on the 2-year bond was 0.123. Okay, remember I always say, how much you getting in the bank on your bank savings? 0.00001. I wasn't kidding. You were basically getting nothing. Okay, then in December of 2021, it went to 0.73. You might think that's not a big deal, but look how much it's up. It's up huge. Okay, so then you go to 2022, it went from 0.7 to 4.4. Probably the biggest jump that I've seen in my whole career. And look at that difference. Okay, so now we're starting to see that come down. So we went from 4.4 is even higher than that to 3.8. So now here's currently what the yield curves looks like. So let me get my head out of the way so you guys can see this thing. So if you look at the yield curve over here, what people say is you have to watch for an inverted yield curve, which basically means the higher yield, you get a higher yield in short terms and lower yields in the long term. So what most investors want, if you're going to tie up your money for a longer duration of time, you want a higher yield for that risk. Well, right now, you look at this, and this isn't even a normal curve. This is kind of a normal curve right here, right, that you're having through here in 2022. And then look at this. As we see, the short end of the stick went way up to here. As you can see right here, the 2-year went basically from here to here. So it spiked and it exceeded actually what the 30-year bonds are trading at. So that's called an inverted yield curve, when the short end has higher rates or higher yields than the long end. Okay, so you have 1-month treasuries all the way down to 30 years. So the 1-month treasury, you can get 4% on a 1-month treasury and 3.6 if you tie up your money for 30 years. Why in the world would you do that? Just keep buying a 1-month treasury over and over and over, and you'll pick up an extra 0.5 point in yield. Just a tidbit to give you on that one. So let's get over to the next piece of this puzzle. Today, what's the actual federal funds rate? 4.58. Why am I asking that? Well, here's what we're saying is, with the Federal Reserve, what's their next move is going to be? So right now, if we have the yield, the federal funds rate at 4.58, okay, what is the futures market telling us that's going to happen to the yields? Well, they're saying we're at 4.58. We're probably going to go to 4.75 to 5 at the next meeting in May. So that means the Federal Reserve is probably going to raise rates another 0.25% right here. Then from there, we start to see the demise. So again, guys, this isn't me guessing. This isn't me, just throwing darts against the wall. It's me watching where the money's flowing. And I want to show you where this chart's coming from, because it's not just some analyst saying, okay, here's what's going on. It's the Chicago Mercantile Exchange. Okay, so this is what the futures market, this is where all the bigwigs are playing and where they're putting their money. And this is what they're saying is going to happen with interest rates. So we go over to here. What in the world are mortgage rates doing right now? So we have on the screen what Mortgage News Daily publishes on a daily basis, and you're seeing it right here on the screen. Let me pop myself back in here so I can join in with you. So what you're seeing right now is the mortgage-backed security on the 5.0. This is what Mortgage News Daily reports on. It is up 25 ticks. So let me explain how mortgage bonds work in yields. Okay, in its simplest terms, here's what this is. As the price of a bond goes up, your yield comes down. So here's how this works in a nutshell. I'm going to show you how if you pay up in price, your yield goes down. Okay, so for example, I buy a treasury bill or I buy a bond, okay, and it's at maturity. Let's say the maturity is next year. I'll get $100, okay. So today I give you $50, okay, $50. Next year you're going to give me my $100 back. So it's a low price. I'm giving you 50 today. You're giving me $100 back. What is my yield? It's 100%. I doubled my money. Okay, that's what's happened. So let's drive up the price. So now I'll go to an extreme. Let's say I give you $100 for that bond, and next year I get $100 back. So I give you a higher price. What's my yield now? I give you $100, you give me $100 back. You're like, Dan, why would I do that? Well, it's an example here. My yield is 0. So when I paid you $50, a low price, my yield was 100%. When I upped that price to 100, my yield went all the way down to 0. So the higher the price, the lower the rates come and the yields. So what you're seeing on here is the market is up 25. So that means rates are going to ease just a little bit. They might come down maybe 0.05 today, but we like the stability in the market. If you see the chart down here below, you can see it right through here. We've had some stability in the last couple weeks, which is great because I hate the seesaw effect like you're seeing in the stock market right now. One day it's up 300 points, the next day it's up 500 points, the next day it's down 500 points, and all over the board. So you really have to, you're throwing darts to figure out an entry point. But right now we just want stability. We want more houses on the market to give you more options and to stabilize prices. And we need rates to come down some to make housing more affordable. So what are the rates right now? Well, according to Mortgage News Daily, who posts this every day and they update it throughout the day. If you want these charts, you can subscribe down below to the Mortgage News Daily, or you can subscribe to my newsletter. It's free. You get this and all kind of other stuff. We are going to make it a paid service here in the next few months. It's going to be really cheap. So if you want to continue to follow and watch live events and stuff like that, we're going to make it really cheap for you. I'll still post videos each day, but I'm going to have a group that are people that really want to focus in on this, and we'll have live events for just you guys only, and we'll do commentations and events and things like that. So stay tuned for all of that. And finally, if you're looking for a mortgage, what do I do? Dan, it's like, Dan, what do you really do? Do you sell stocks? Do you do this? No, I'm actually a mortgage advisor. I run the Frio team here at Allied First Mortgage, or Allied First Bank. We are one of the federal chartered bank, which means we can help you all over the country, but we're also one of the country's largest mortgage brokerages. So if you're in need of a mortgage, check us out. And if you don't read English very well, I just added this yesterday. So for any of the Hispanics out there, I'd love to help you guys out as well. All you have to do is click the button right there and it'll translate for you right to that. And we are bringing on some Hispanic speaking loan officers to help you guys out because that is a big need. So other than that, I'll be back today at 3. I'm going to try. I have 2 big meetings today, but hopefully I'll be back at 3 o'clock. I will be posting to let you guys know if I will be, and we'll have our live event at 3 that I can answer any questions you have in regards to Scrub. What is Scrub? Well, stocks, crypto, real estate, and bonds. So we'll have that talk at 3 o'clock today. So thank you so much for watching. God bless. Have a fantastic day, and I'll see you at 3. Bye-bye.